Yeah, look, our view is that after years of underperformance, that it's quite dangerous to be too underweight China. And actually, in emerging market positions, we have done that. We've reduced our underweight positions. We think that in January, at the end of January, when the government came into the A-share small cap market, that was almost a floor on the market. But you have to be very selective, Sri. It's very much about those companies that are beating earnings and avoiding those companies that look like they're going to not beat earnings.
And hard to be structurally positive in the current environment, Sean. Is that because we don't have a fiscal a boost, a major one, and is that part of the more nuanced approach that you would be taking and advocating?
But we really look into the numbers and the earnings numbers, and although you're beginning, the fourth quarter is probably looking like 9 or 10% up in local currency. Obviously, you've had weakness in the currency, so when you translate into that US dollars, it's less. But the revisions continue to come down, and so actually over the last year, you've had earnings revisions in China come down by about 16%, and this year even, we started off with roughly 18% earnings for the MSCI, and it's probably going to come down to 10. It's about 11 or 12 at the moment. So, we need to see earnings expectations stop being revised down and to be revised up, and then really see the structural stories come back. The second is obviously on risk premium, and that goes with what's happening with geopolitics, which actually in the last 24 hours seems slightly better. But then around what's going to drive foreign investors to put more money into China, particularly US investors, and we see it quite. It's going to be quite a difficult hurdle before the election.